Good afternoon, ladies and gentlemen. I'm Megan Olson with the Investment Advisor Association, and I welcome you to our webinar, Avoiding Trade Errors, Best Practices and Learning from COVID-19. During the webinar, all participants will be in a listen-only mode. You may submit questions to the speakers at any time during the webinar by typing them through the chat feature. Only the speakers will see your questions. Questions will be addressed as time allows. As a reminder, today's webinar is being recorded July 16th, 2020. I would now like to turn the presentation over to our moderator, Paul Glenn, Special Counsel at the Investment Advisor Association. Paul.
Thank you, Megan, and thank you each for joining us today on this call, whether it's right this second or some months away, depending on when you're listening to it. But we appreciate our speakers today, and we have an interesting set of topics for you on the best practices and learning from COVID-19. Has to do with trading errors. I don't know whether all of you have had to deal with those problems. If not, maybe you will. But I'm welcoming, our first speaker is Rick Marshall. We go by Rick, Richard Marshall. He's a partner in the Catton Law Firm in New York City. And he has served several years as a branch chief in the SEC's Division of Enforcement in Washington, D.C., and as Senior Associate Regional Administrator in SEC's New York office. He's been with major law firms, and we're delighted that he can join us. He also is the founding editor of Investment Lawyer, among other honors. Also, we have Steve Johnson, and Steve is an attorney, and he is Vice President and Associate General Counsel for Charles Schwab Company, Inc., and has represented the financial services industry for more than 30 years. He's currently Enterprise Counsel for Schwab Advisor Services and Schwab's Digital Services Organization. He also has served as General Counsel of Cyber Trader, Inc., and Counsel to Schwab Investor Services. Before joining Schwab, Mr. Johnson was an Assistant General Counsel at Prudential Securities and in private practice in the financial services industry. So gentlemen, welcome, both of you. Both of you have interesting experiences that I'm sure will be helpful to our audience today. And next slide. So anyway, I was giving you descriptions of them, and there we go. The pictures are too, so you can see. But we will be having, the pictures will be showing up in the lower right-hand corner, at least of my screen, as to whoever is speaking. And hopefully that's working for each of you. You should be able to just listen to it too, if you want, however it works best for you. So some of the things that we'll be talking about today is what is a trade error, who pays for a trade error, the importance of prompt resolution, how to measure the costs of errors, mechanics of error correction, and disclosure of error policies. And finally, best practices and procedures. And we'll have an interesting case study that you can sort of apply it to figure out what you would do in a similarly situated situation. So with that, Rick, let me turn it over to you to start us off with that question of what is a trade error.
Sure, and if you go to the next slide, we're going to have a little introduction here, but it's a good place to start. I'm not going to speak for my co-panelists, but I think I'm viewed as an expert on errors. Errors are part of my life, so I bring vast experience with making mistakes. Why is this important? Why are we talking about this now? There are two characteristics of the current environment that I think makes this particularly important. And certainly in my experience, there have been more difficult issues that have come up recently. The first is with everybody working remotely, they're working frequently from not the setup in the office with the big, screens and the keyboards. They're working from maybe what I am, from a very small keyboard. And working remotely, number one, leads to the possibility of the kind of mistakes we're going to be talking about. It's also harder to supervise people in this environment. That is a subject that we could spend a whole separate hour on, and we're not going to spend it here, but it's just with everybody working remotely instead of in one central location, it's harder to keep an eye at people and get things on track. The second thing that's made this more important, more interesting now is the volatility of the market. The markets have been really, really volatile for the last few months. There was certainly a stretch when they were extraordinarily volatile. And when we get to measuring the cost of an error, we will clearly see that volatile markets make errors more expensive. If the error costs $300, you're not going to spend hours and hours agonizing over it. But if the error costs $3 million, it becomes much more important. So the two things together, the remote working and the volatility in the markets, have made this, we think, a particularly important area to cover now. So the first thing to talk about, which is why we have on this first slide, is what exactly is an error? And it might seem simple, but it's actually not as simple as it might seem. And first of all, no regulator, including the SEC, has ever given some kind of precise, comprehensive definition of what trade errors are. And you'll see in a minute why that's important, because let's talk about what's not an error. So let me give you a concrete example, and I apologize for the background. There's nothing I can do about it. I guess there's a fire nearby. But suppose, let's take an example. Suppose, and this is a real example, several years ago, Warren Buffett thought that airlines were a very good investment. So he bought airline stocks. He picked them exactly as he wanted to. He figured out how much he wanted to buy. He bought exactly that amount. He figured where he wanted to buy it. It went into the place he wanted it to go in. Unfortunately, a couple months ago, he decided, Warren Buffett, that airlines were not going to be a very good investment for a while. So he sold out all of these airline positions. And he said he, I guess, lost billions of dollars, and he said this was just the worst mistake he'd ever made. Are we going to be talking about that kind of activity on this program? We are not. Now, how is that different from what we're going to be talking about? Well, what Warren Buffett did was intentional. He did exactly what he intended to do. What investments, what amount, where it went, and it turned out that that was not a very good investment. It lost money. Is that something that can be interesting? Can that raise regulatory issues? I'm not saying that what Warren Buffett did raises regulatory issues, but we all know of occasions where somebody intentionally makes an investment decision and it's conflicted, and the conflict isn't disclosed. Or they don't exercise due care. It's not suitable for the client. And in those cases, you can have a problem. You can say, that was wrong, but it was exactly what the person intended to do. The investment advisor did exactly what they intended to do, and then legally that may raise issues. That's not what we're going to be talking about. So what are we talking about? We're talking about situations where a person doesn't do what they intended to do. And by the person, I mean the advisor, the registered entity. For some reason, which we'll go through, they didn't do what they intended to do. So for example, failure to properly execute an instruction of a portfolio manager. So the portfolio manager says, buy Tesla. And the trader doesn't buy Tesla, he buys General Motors. Well, that's not what was intended. Some mistake happened there. There was some miscommunication, or the trader hit the wrong button. Or instead of buying Tesla, the trader sells Tesla. Again, not what was intended. Somehow he hit the wrong button. Somebody miscommunicated. Something went wrong. It was not an intentional act. Or the portfolio manager says buy 10,000 shares of Tesla, and instead the trader buys 100 shares of Tesla. Again, it's not what was intended. It's a mistake. And how it happened, that's an example of the kind of problem we're going to be talking about. Now, there are other less obvious examples of trading errors. So for example, the investment guy, let's say you can only buy investment grade bonds. And you make a mistake, you look up, you think the bond is investment grade, but it's not. Well, that's not what you intended to do. You intended to buy an investment grade bond and you didn't. Reconciliation, and Steve is going to talk about this process, which is really critical for good compliance, where you try to compare what you wanted to do with what you actually did do. And unfortunately, that system can break down so that you don't pick up an error very quickly. Limited orders versus market orders. You only wanted to buy if the price was no higher than 55 and you bought at 80. And you said, it just should have been a limit order. It was a market order. It's a mistake. The client tells you to do something. Client says, sell out a third of my position. And instead of selling out a third of the position, you sell out the entire position, leave them completely in cash, because somehow there's a miscommunication between whoever took the client's instructions and the trading desk. And then let's say you buy something and there's no money to pay for it because you looked up and you said, oh, this client has $1 million in cash. I'm going to put that to work. Well, the client didn't have that. That was just a mistake. Next slide, please. We've got some other examples, and what's common to these examples? What's common to these examples is a situation where the investment advisor is not doing what they intended to do. That's why it's different from Warren Buffett buying airline stocks and then saying, oh, the dumbest thing I've ever done in my life. That's not what we're talking about. That's analyzed differently. So, you know, an order goes to the trader, and this has been happening in the last few weeks quite frequently. Instead of being executed quickly, it doesn't get executed quickly at all. Maybe not even the day it was supposed to be executed. It might be a day or two later because of delays, communication with the broker, the trader's internet crashed, all of these problems. And then here we have lack of communication, which causes trader A to execute trades already being executed by trader B, unbeknownst to trader A. So you have no actual entry, you just have miscommunication, a very difficult problem when everybody's working remotely. These are examples, and Steve, I don't know if you want to jump in at this point, but the key point here, and I'm about to talk about the standard of care, which is the final thing to mention, but the key thing, it's not like Warren Buffett, who did exactly what he intended to do. These are cases where the advisor did not intend to do what happened. And Steve, any other examples you want to talk about?
Let me just a couple of quick comments. So, you know, I on a day-to-day basis serve as the counsel for the advisor services business at Schwab. So that's our custody business for independent advisors. So the comments I'm going to make today are from that perspective. What do I do on a day-to-day basis? And I think some of the things I'm going to say sound somewhat simple, somewhat basic. But I think in times like this, as you just described, Rick, in these volatile markets where we're all working in a unique environment, working from home, these basic things become even more important. They're sort of the building blocks of making sure things happen properly. So I'm going to repeat a lot of those today, and I hope I don't sound a little preachy when I do that, but I think they're really important to emphasize. What I was just going to highlight here on what's a trade error, for those advisors who make custody at Schwab, we define in our trade error policy for independent advisors, what is a trade error? So we give some examples and we make those available so folks can see what we consider to be a trade error. At Schwab, that's found in our service guide, the trade error policies in our service guide available on schwabadvisorcenter.com. And it's really important because what happens in a typical situation, it's a series of facts that happen, and we have to determine if in fact it is a trade error. So that's the starting point for all of this analysis. Is it in fact a trade error? Is it the advisor's trade error? Is it by chance the custodian's trade error? So that definition becomes really important. And I just wanted to highlight that, Rick, before you turn to the next section.
Yep. That's very helpful.
Another question has come in from our audience. Says, if the investment advisor has discretion, then is failing to enter a portfolio manager's directed trade or trading a day or two later still an error?
It can be. If what was intended is to execute the order as quickly as possible, and let's suppose there's internet failure and the trader doesn't get the message for 2 days, that could be viewed as an error because you've missed what you intended to do. You did not do what you intended to do. What you intended to do is get that order executed as quickly as the market would permit, which is not 2 days. So the answer is, even with full discretion, that could be classified as an error. And then we get to all the consequences of that, but that'll be for the next slide.
Let me ask one question that I'm interested in your reactions to. It has to do a little bit with your first bullet, said failure to properly execute an instruction of a portfolio manager. Well, I'm thinking of a more passive situation where let's say you have, our intention is to put you in, you talked about certain grade of bonds, and but we want to keep you, let's say, at 60-40, so 60% equities and 40% bonds. Well, the bond market goes down and you've had some good equities, and it's a lot higher. It's creeping up, but you're happy because you're making money. Is there any trade error there, or what is anything that touches on what we're talking about here that we should think of?
That might not be a trade error. If you have discretion to adjust, 60-40 is not a rigid formula. It's kind of aspirational targets. And you have discretion to override that, and you make an intentional decision to override that. It may be a dumb thing to do, but it wouldn't be an error. That would be analyzed in a different way. But if you have a formula, if the formula says, which I've never seen, but if you had, let's say, at the end of every day, you have to be exactly balanced 60-40, and you don't do that, then there might be an error in place because you have an instruction that you have to follow and you're not following it. Probably in the ordinary course, I don't think it's very common to have that kind of rigid formula. In the ordinary course, you have some leeway, and if you override 60-40 for business reasons, that's like Warren Buffett buys airline stocks. It's an intentional decision. It may be dumb. There may be other legal theories under which it could be prosecuted, but it's not going to be what we're talking about today. It's not a trade error.
So would I apply the same analysis if you did buy that Tesla back when it was, and now you have a provision in your agreement, or the way you think they're managing it is that no stock is going to be greater than 5% of your portfolio. And it quickly gets more than 5% of your portfolio, you're happy as can be, but is there any trade error there?
Again, it depends on whether you have discretion. If it's just a guideline, the 5% is just a guideline. If you decide to override it, you're doing exactly what you intended. It may be dumb. It may be actionable depending on the facts, but it's not what we're talking about here. It's not a trade error. If you have a formula at the end of every day, you're going to sell a position if it gets over 5%, and you don't do that, that would be the kind of thing we're talking about here.
And I think
Hey,
yes, Steve.
To go back to your question a second ago that you got in the chat session, and what you described to us at Schwab, we'd call that a missed order. And we would want to know, we'd want to see some documentary evidence, something to reflect that in fact an order was intended to be placed. So we could consider it a trade error. We would call it a missed order, but you'd have to have some documentation of the client's, or in your case, the portfolio manager's intention to trade. And so there's something that was really clear that there was an instruction that was missed.
I think those are all very good points. And one more reminder I would suggest is that you pay close attention to how you have some of those things written, so that you do have enough flexibility in what you're expecting the advisor to do, that they can do what's appropriate under the circumstances. And you're not artificially selling, like Steve implied, every afternoon you're selling 2 shares of something just to stay within some parameter. So here's another question that's come in. It says, with regards to volatility, can market movement cause a trade error, even though the advisor did not take any action to cause a client to violate its guidelines? I guess that's a little bit like what I was maybe asking about, but.
Yeah, that's where you get out. I think what they're getting at is getting out of guidelines 60-40, no more than 5% in any one position. And normally you would have discretion to override that. But if you make an intentional decision to override, that's not an error.
Excellent. Okay. That kind of,
Then the final point, we're going to have to move on, or we're going to spend the whole day on what's an error. An overriding issue, particularly for institutional clients, is there a standard of care that has not been met? So, we all probably know that last year the SEC withdrew the Heitman no action letter, which talked about hedge clauses. The normal hedge clause said that advisor is not liable for simple negligence, but it is liable for gross negligence. There's doubt now that that no action letter is withdrawn, whether or not those kind of hedge clauses are valid or not. But there's often a question, because a lot of advisory contracts do say the advisor is not liable for simple negligence. Well, if the advisor did not fall below the standard of care to which it was held, so its conduct was simple negligence, then it would not be an error. But if they do fall below, in the case of let's assume that the pre-Heitman hedge clause is valid, so the advisor was grossly negligent, then they have fallen below the standard of care. Now, that's very difficult because the distinction between simple negligence and gross negligence is very subtle. Simple negligence is failing to behave the way a reasonable person would do in the circumstances. Gross negligence is something more irresponsible than that. On the continuum, recklessness, which is up above gross negligence, is an extreme departure from the standard of care a person would follow. Gross negligence is less than an extreme departure, but something more than just what a reasonable person would do in the circumstances. And the takeaway point, if the hedge clause is deemed to be valid, and we could do a whole separate program on that after last year's withdrawal of the Heitman no action letters. If the hedge clause is valid, so you're not liable for simple negligence, that's not enough to make it a trade error, but you are liable for gross negligence. Where do you draw the line? And that can be very, very difficult. And we have a hypothetical about that at the end. So let's go to the next slide, because we have so much to cover. So we've identified something as an error. Who's supposed to pay? It ultimately comes down to a couple questions. First of all, who's responsible? Is the broker, the custodian, liable? There can be an error, for example, where you correctly sent the order to the broker and the broker made the mistake. You said to the broker, I want you to buy 100 shares of Tesla. Nobody disputes that. And the broker just botched up. They made a mistake. They bought 100 shares of General Motors. Well, the advisor, there was an error, but it's not the advisor's error. It's the broker's error. Can that go to, can that be something that the advisor could be responsible for? Well, if they picked the wrong broker, if they didn't do due diligence on the broker, if there was a pattern of errors, it's possible. But it could be the broker's responsible. The advisor is generally liable as an entity. How about the employees of the advisor? Well, the entity is strictly liable for the mistakes of its employees. So the advisor would always be liable. Could an employee also be liable? That can happen. More often than not, it's only theoretical because the employee doesn't have the money to pay and they're not going to pay without litigation and it's not worth to litigate. But I've certainly seen situations where, and particularly since people have been working remotely, where the employee doesn't follow firm procedures, and by not following firm procedures, that leads to the error, and the firm comes to the conclusion, we told people, we trained him, we wrote it down, we told him to do it this way, this guy didn't do it that way. Maybe we're strictly liable for their error because of doctrines and law, but I think the employee should pay for that. And that's absolutely fine. And then Steve, I think you have great experience with indemnification and insurance. Could there be a situation by contract where a third party might be obligated or where an insurance company might be obligated? And Steve, can you speak to that?
Yeah, I mean, my first practice pointer here relates to insurance. Again, it's going to be one of those sort of self-evident things, but at Schwab, we see across the spectrum advisors probably an overall lack of insurance or maybe underinsured. And so, when I have a chance, I like to remind advisors of the importance of proper insurance. And this is one of those areas. And I'd recommend you go back and check your coverage to see if you could get coverage for trade errors. Check your deductible and take a look at both of those. Typically, coverage under an insurance policy is very fact specific. So you can't guarantee that you're going to get coverage under your policy, but it's also important to properly notify your carrier and notify them in a timely manner. So my first practice pointer relates to insurance. I think it's a good practice to go check and see if you've got coverage for trade errors. Just to highlight one other thing too, you referenced if the custodian's potentially liable. We make that clear in the Schwab trade error policy. If we're responsible, we're going to correct the error at no cost to the advisor or to the client. I do like to remind advisors if we have something that they think Schwab caused the error, we've got to notify Schwab within 10 business days, and we spell that out in the trade error policy as well.
One other related question that has sort of come up has to do with, is there opportunity to offset errors that are profits and losses, or merge them together, or stretch them out over some period of time? What flexibility is there?
We're going to be talking about that in a couple slides, but generally speaking, that's what's called netting, and it's all spelled out in the restatement of trust, which has a whole section about errors by a fiduciary. Netting, which is basically, well, we'll give an example a little later, but one error costs money. When you go to correct it, you commit another error. Let's suppose you wanted to buy Tesla. Instead, you bought General Motors. You go to correct the error. You lost money on General Motors. You go to correct the error. Instead of buying back in Tesla, you buy, I don't know, Movideo, some company that's inventing a cure for COVID, and it's even better than Tesla. So you have a profitable error. You have an unprofitable error. If they're related, you can net the profits and losses. If they're not related, you cannot. That's what the law says, and then you have to look at your disclosure. What do you disclose? What do your policies say? Normally, I would say 99% of the time I'm asked about netting, the answer is you can't net. Either because the law says the errors are not related, the losing error and the winning error are not related, and or your disclosure and your procedures don't properly provide for it.
Thank you.
And then I guess, can a client be forced to pay for an error if it's the client's error? So the client calls up and says, I want half of my account reduced to cash. So you do that, and the client says, oh, I made a mistake. I meant 10%. Well, the client made the error, so you go buy back in. That's the client's mistake. Other than the situation where the client made the mistake, where there's no error by the advisor at all, the client can't be forced to pay for an error. It's the advisor who pays for the error. And then let's go to the next slide. So this is just sort of common sense. Time is important. Volatility makes time even more important. Potentially, as the markets move, the cost of the error becomes greater. Sometimes not, but usually markets are volatile, and as time goes by, the cost of the error becomes greater. Errors don't just disappear, just hoping it'll go away. That's not going to work. There's a mistake, and the mistake has to be corrected. And concealment itself may breach a fiduciary duty. So if you find, oh, we meant to buy Tesla, instead we bought General Motors is down, let's just cover that up. Well, that's a breach of duty. That's a violation of the Advisors Act. It's a violation of state law. So just sitting around hoping the world gets better is not doing any good. It's actually committing a violation. And then you have to worry about the time value of money. And we're going to talk about that later. That means interest. So every day that goes by, if the error cost $1 million, you add in interest, more interest, more interest, more interest. Right now, interest rates are very low, but they're not zero. So speed in identifying and correcting errors is absolutely essential. And Steve, I'm sure you want to speak to this.
Yeah, I mean, the first thing I'd say is if an advisor notifies us of a trade error at Schwab, we're going to immediately cover that position. We're not going to let time, pass. We're going to take action as soon as you let us know that there's a trade error. So that's the first thing I'd want to say. Again, I have another practice pointer on this slide. It's sort of self-evident, the importance of just making sure you're properly reconciling your trading, making sure you review your positions at the start of the day, at the end of the day. We trade oftentimes at Schwab in what we call a master account, and separately we have a block trading account. Make sure you're looking at those accounts at the beginning of the day, at the end of the day, and reviewing and reconciling them appropriately. Again, it's important to timely notify your custodian of any trade errors. If you think something's a trade error, let us know, let the custodian know. And also, as I talked about on the prior slide, if you have insurance coverage and you have a trade error, it's important to let your insurance company know as well. Don't forget to review the downloaded information that you get, along with statements, confirms, and the other things that traditionally are shared.
Okay, should we go to the next slide?
Keep going.
Yeah. Well, this is probably the hardest part of the whole exercise. How do you measure the cost? And this intellectually is quite difficult. First of all, there's a general principle in trust law which says that if the fiduciary, we say the advisor being a fiduciary, makes an error, the fiduciary's job is to put the client in the position the client would have been in if the error had not occurred. So let's take a concrete example, and we're going to do this at the hypothetical at the end. So the portfolio manager tells the trader, buy Tesla. I want to buy 100,000 shares of Tesla. The trader makes a mistake and buys 100,000 shares of General Motors. Not what was intended. Somebody's messed up. Maybe it's negligence, maybe it's gross negligence, but somebody's messed up at the advisor. So now what happens is when you detect this, General Motors has gone down $1 million. You didn't ever want to buy General Motors, but you did. It's down $1 million, so you sell out that position at $1 million loss. But Tesla has gone up $1 million between the time of the order and the time it's detected. So if the client had gotten what you intended, not only would they have not incurred that $1 million loss on the General Motors trade, they would have gained the $1 million profit from the Tesla trade. So that points out the question, what's the cost? Is it $1 million, the loss on the General Motors position? Is it $2 million? Not only the loss on the General Motors position, but the gain that was missed, the opportunity that was missed from the Tesla position. And it gets even more complicated because sometimes there can be scenarios where, okay, so Tesla went up $1 million, but the portfolio manager had an algorithm where once Tesla went up by 3%, he was going to put on an option and therefore take an even more aggressive bet on Tesla. And that algorithm would have been triggered if he'd bought Tesla. So not only did the client miss the $1 million profit, they missed another $1 million profit on an option that would have been purchased if originally it had been Tesla that had bought, not General Motors. So is it the $1 million loss on the General Motors, the $1 million gain that was missed on Tesla, and then that additional $1 million gain that might have been gained if that option trade had been triggered, and there could even have been more profit on Tesla. Well, that's very complicated. The answer on trust, under trust law, and the famous case is the State of Rothko, which is a very, very difficult case, which goes to the question of how do you measure the amount that a fiduciary owes when they make a mistake and hurt the beneficiary? Well, under trust law, You'd say the $3 million. You would say you put the client in the position they would have been in if everything had been done as intended, if no error had occurred at the fiduciary, at the advisor. Now, is that so clear? Well, the law, this has been litigated quite often, and the law is certainly going to say the client should not have to eat that $1 million loss. That $1 million loss, that General Motors position that you didn't ever want to buy, that went down by the time you detected the error, you're going to have to give the client the $1 million back. The gains that were missed are more speculative. And the more and more speculative they are, the more willing the courts are to forgive a fiduciary for those costs. And so it gets to be very complicated when you get into situations about lost opportunities. Now, in my simple case, you just wanted to buy Tesla, so Tesla went up $1 million. But then when you get in the, but the market was moving, it would have been another $1 million that might have been made and all this. It gets to be kind of speculated. The more speculative it is, the more reluctant the courts are to imposing those costs on the advisor. What's critical? Disclose how you're going to do it, have procedures by measuring the cost of the error, having procedures that follow this, and think about these issues carefully. These are very difficult and very important issues. Is the time value of money part of the cost of correction? Again, fiduciary law says yes. And that's why being quick is so important. So it took you a week to figure out what happened. So the client lost the value of its investment. There's a time value, there's an interest component to that. And that's normally what trust law would say should be included in the cost of an error. Now, interest rates are very low now. It's usually not a lot of money. Hopefully you pick things up fairly quickly. Other times interest rates have been higher. Again, what do you disclose to clients about time value of money in connection with errors? What do your procedures say? Then the last two are among the most difficult issues of all, and these are all very difficult issues. What happens if you have an error that affects lots of client accounts by very small amounts? So maybe it's a $100,000 error, but it affects lots and lots of clients, and the costs of going out and making the clients whole are really more than what the client's going to get from the correction. Trust law says that it is permissible to take that factor into account. You don't have to spend $30 to give clients 2 cents to make them whole for an error that you committed. That's not reasonable. It's not necessary to go to that extreme. And this can come up sometimes. The law here is very unsettled. It's very unclear how far the SEC will let you go with this. There are some kind of informal rules for correcting NAV errors at registered investment companies, which do recognize certain de minimis errors don't have to be reimbursed to clients. But it's very unclear here. If you're going to go the route of saying it's too expensive to compensate clients, so we're not going to do it. Number one, look at your disclosures, look at your procedures, and this is something that has to be analyzed very carefully under the law. And then the final point, which we talked about earlier, is netting, which comes up all the time. So to take my example, the portfolio manager says, buy Tesla. Instead of buying Tesla, you buy General Motors. When it's detected, you've lost $1 million. So when you detect the error, you say, oh my gosh, we should have bought Tesla. Instead, we bought General Motors. And instead of going into Tesla, you buy some drug stock, I don't know, Movidian or something, hit the wrong button. And it turns out Movidian does 10 times better than Tesla because they're supposedly developing a cure for coronavirus. So you make a ton of money on that. And you say, oh my God, now you detect that you bought this drug stock. You say, I don't know anything about drug stocks. I didn't intend to do that. Let's get out of that. But I made a ton of money. If those errors are related, and they would be in the example I gave, trust law permits offsetting the profit and the loss. But if they're not related, you can't offset. It's not permitted under trust law. It's just simply illegal. And so one day you want to buy Tesla, instead you buy General Motors. 3 days later, you wanted to buy American Airlines, and instead you bought JetBlue. Those two areas have nothing to do with each other. And if one made money and the other lost money, trust law does not permit you to net gains and losses on those errors. Again, disclosure and procedures are critical here. And I would say this is an area, there is clear guidance in trust law about when netting is okay and not okay. Very seldom is netting okay under trust law. And so if you're going to try to do netting, and when we talk about error accounts, that's where this comes up all the time, that can be a very difficult analysis to say it's okay to net. Steve, did you have any thoughts on this very difficult issue before we move on?
No, keep going. You nailed the netting issue really well.
Rick and
Okay.
Steve, one other question that's been raised has to do with the people. So if an organization has responsibility for determining whether a particular scenario fails to meet the standard of care or not, and therefore whether it's a trade or not, who at the organization should be responsible for that? I suppose it's a lot of different answers, but is there any principles I should think about?
Well, the chief compliance officer should definitely be involved because the SEC will look to them. If there is a chief legal officer, a general counsel, these are difficult, subtle issues, and they should be involved. If there is no chief legal officer, it wouldn't be uncommon to consult outside counsel, particularly if there's a lot of money involved. But I think we're going to, in the hypothetical, we're going to highlight the fact that it isn't just the portfolio managers and the traders who have to worry about this and the accounting people. It's sometimes the compliance officer or the legal officer when they go to address how to correct the error. And normally you would always have the chief compliance officer in the loop. So let's go back to the next slide. And we've got to hurry here because we're going to run out of time. So you find an error and you say, oh my God, I don't want to put that into the market. I'll just take it into my own account. So the advisor says, oh my God, General Motors, I didn't want to buy that. I'll just buy that into my own account. That's a problem. That's a principal trade. What if you say, well, you know what? These accounts, General Motors was no good, but I actually wanted to buy General Motors for these other two accounts. So why don't I just move it from one account to another account? That's a cross trade, and that raises all kinds of regulatory questions, which we could talk about for an hour. So be very careful about that. And then using an error account. So it's basically sort of a house account in the name of the firm, and you process the errors into that account. So the General Motors stock goes into the account, goes out of the account, and you basically use this for netting. You get into principal trade issues there, maybe cross trade issues. You also get into netting issues. So use of error correction accounts, it has to be looked at very, very closely. There's a lot of regulatory problems that are raised by that. And then what about telling the clients? My points on this are basically twofold. If you're giving the client money, you don't want to tell the client you made a mistake, but unless the client is asleep, they might well say, where did this $30,000 come from? Or why did you wire $50,000 into my account? Legally, under fiduciary law, a fiduciary is supposed to inform the beneficiary, so the advisor is supposed to inform their client that they've made an error. And that certainly should be the place to start. And I can't imagine a client just gets money and they don't ask, where did this money come from? Do you have to say, I'm bad, I'm terrible? No, you don't have to tell them that. You can tell them, we made a mistake, we've corrected it, and that's hopefully the end of the matter. Steve, do you want to speak to any of these issues?
Nope, keep going.
Okay, all right. So now, disclosure of errors policy. Next slide, next slide. I've emphasized this over and over. The questions come in, what if the error is detected before settlement? Can you then move it around? You have a better argument So before the trade settles, the trade has been executed. You bought the General Motors yesterday, but the trade hasn't settled. Can you then move it into a house account before the trade settles, or move it from client account A to client account B without worrying about principal and cross-trade issues? You're in better position in that case. You can certainly make arguments that you're not engaging in principal and cross trades. However, it is very aggressive to do it that way. And I don't know what your experience is, Steve, but we generally don't recommend, even if the error is detected before settlement, that you correct it by buying it into the advisor's account or moving the erroneous position from one client account to another. What's your practice, Steve, on that?
You know, the question is not as frequent as it was before the settlement dates, the settlement timeframes got tightened. You know, I would look at it in the same way I'd look at anything else. Is it a trade error? Yes. As under fiduciary principles, the advisor is responsible for any losses, and any gains go to the client. And we would probably follow that pretty carefully pre and post settlement.
Yeah. So even if the error is corrected pre-settlement, I think you have to look very closely at whether or not you could do something that would be a principal or a cross-trade post-settlement. And as Steve correctly points out, now that the period between execution and settlement has been shortened, it doesn't come up as much. The next slide, and I'm sorry, we got to keep moving along because we've got so much to cover here. Now back slide, back one slide. I'm sorry. So we've talked over and over again about disclosing your trade error policy. First of all, that's a good idea because it forces you to think these things through. How are you going to measure the costs of errors? What are you going to do about netting? What are you going to do about negligence versus gross negligence? There's all these issues that it's good to think through and write it down. And so the disclosure, so that basically, it helps you to think through, but also telling people what you're doing here. What you're dealing with errors is breaches of fiduciary duty, negligent failure to exercise due care, and you want to put it in the ADV. I actually don't think it's all that critical. There's no section in Form ADV that says talk about your trade error policy. There are places where more often than not it appears, but it doesn't cause me to become hysterical if it doesn't appear in those sections. But ADV is a good place. Contracts with the client is another place to put this disclosure. And the more detail you give is important, the more aggressive you are on some of these issues that we've been discussing. So for example, let's suppose that you're going to have a very aggressive netting policy. You're not going to give clients the lost profits, the lost opportunity costs. So you're not going to give them the time value of money. Well, this is a very aggressive reading of your fiduciary obligations. And the more aggressive you are with those type of interpretations, the more important it is to have client consent. And client consent requires disclosure to clients. So saying something about your error policy is certainly important. I would say always you should have something about it. But when would you want to have it in a contract where the client consents and you spell out all these things in excruciating detail? When you're being very aggressive on taking interpretations of what your fiduciary obligations are. And the more aggressive you are, the more risk there is that without a sophisticated client, clear disclosure, and informed consent, the greater risk that you're just not going to have something that's valid. So Steve, I know you've got some practice pointers here. What are your practice pointers?
Yeah, I think this is such an important topic. I wanted to jump in on this one. You know, we recommend at Schwab that every advisor have a disclosed trade error policy. In the trade error policy that I was referencing before, we actually provide model language for an advisor to use. Obviously, that model language that we suggest has got to be tailored and be consistent with an advisor's trade error practices. So we put that out there to say, hey, this is the default that we're going to follow if you don't have a model, if you don't have your own disclosed trade error policy. We also recommend that you regularly review your ADV disclosures and how you handle errors. And I think it's important that you review it periodically, probably annually. Make sure your disclosure is consistent with what you're doing. We've seen that. Make sure how you're handling your errors is actually how you're disclosing it. And one thing that we've seen too on the disclosure side is people will talk about how they handle losses, but sometimes there's a lack of clarity on how they handle gains. So make sure you have disclosure how you're going to handle both gains and losses.
Mm-hmm. And
one other question came
go ahead.
in. I'll try to make a quick answer, but it had to do with that follow-up to the error that's corrected before settlement. So, well, how about fixing an error before it's posted to a client account in the case of a mutual fund? Because they can sort of settle the next day is when it would take place if they haven't done it before 4 o'clock, I guess.
Yeah, I mean, there's room to correct an error. If you detect an error 5 minutes later, and you haven't even booked this can be solved with the reconciliation process. So this happens all the time. During the day, you detect, oh, we made a mistake accounting-wise, let's correct that. I don't think that raises any issues about principal trade, cross-trading, that kind of thing. Once you get past the end of the day, even if it's not a mutual fund, you start to raise issues about, so it's after the end of the day, but before settlement, you still have to think long and hard about how to correct it. But if you pick it up right away and fix it, I don't think you have to worry about all these issues with principal and cross trading.
Okay.
Steve, do you disagree with that?
Well, that was good. I agree.
Okay. Next slide. And Steve, do you want to talk about best practices here?
Yeah, I will. I'll go down my list of things here. I would start with training and education. Make sure your team's trained on how you handle your trading and your error resolution process at your firm. So make sure you train and educate. Make sure you have good policies and procedures over order entry and execution. If it's appropriate at your firm, separate the function of portfolio manager and trader. One that we've seen that's very simple, it's important, is just verification of your positions prior to order entry. I know I mentioned that earlier. And these are more trading practices. So I know I'm maybe going a little off script here. I've got some input from my trade team, the trade desk at Schwab. So thank you guys. A couple of them are on the phone are on the call here today. So I've sort of stealing a little bit from what they've told me they observed during sort of the volatile time periods, especially back in March when things were really, really volatile. So a couple more things here. And if you're trading a block, make sure you verify the total securities that you're going to be traded in your block. Be really clear about your communication of your trading requirements. So precise trading requirements get communicated. Sort of self-evident again, but after every trade execution, immediately review it. Review your trade executions immediately. And then a couple more things here. Supervisory sign-off at the end of the day. I think that's really important. And then one I've heard firms that's a really solid practice is to look back maybe quarterly or monthly. Look at your errors that you've had over that time period. Look at what your error history is, and should you make some changes? Do you need any changes on the training side? Do you need changes on your procedures? What's going on at your firm and your shop? So that sort of look back on a regular basis, either maybe quarterly, but also monthly, could be helpful in a time period like this. So with that, keep going. Unless you wanted to add something to that slide.
No. Next slide.
Yeah, and I know you want to leave some time, Rick,
Go ahead. I'll do it in 3 minutes. Go ahead.
Okay, so I'll go quickly. Again, these are the reminders that I got from my trade desk partners. So I find these to be maybe a little bit out of the advice of the lawyer and the legal team, but I think they're really practical and really helpful. So first one is, it seems really self-evident. You had a volatile market. Avoid using market orders when limit orders will do. We saw that, with more frequency than you'd expect, especially in really volatile markets when maybe the market gapped up or down at the open. So use limit orders when you can. Pay attention to the order types and what you intended as the time and the means of execution. Make sure you've got good controls and practices for both pre-market and aftermarket trading, where certainly errors can be magnified in those market conditions. All right, let's turn to the next slide. We got into this a little bit earlier, but let's make sure we really focus on allocate your block trades in a timely manner. At Schwab, we ask for the allocations to be in by 5 p.m. Eastern time on trade date. That's really important. Make sure your client's account has certain cash is available and really can support the trade that you want to enter in your client's account. A couple more here are, we provide trade edits. I'm sure the custodians and trading systems that you guys use have edits. There's trade edits that are provided to you. Please pay attention to those because they can be really helpful. And a couple of final tips here too. Check the notional value of a trade prior to submission. Just manually checking that amount can help you maybe spot some mistakes, some potential errors. And then for option trades, pay attention to all those details. Clearly, there's maybe potential greater risk on an option trade. We see folks maybe not paying attention to all the details, such as the number of shares each contract represents, the settlement date, the notional exposure, and then whether it's cash or physical settlement. So pay attention to those option contract details that matter. And so those are a quick run through of just some trading practice reminders. And there's your 3 minutes, Rick, to run through our hypothetical.
Right. So let's go to the next slide and then to the next slide. So we've only got a couple minutes and I have to leave Paul some time to wrap up. So real quick, the whole point here is that it isn't just the trader and the portfolio manager who can be involved. Compliance officers, legal officers can be involved in, by the way they address the error, making mistakes themselves. So here you've got the error, they wanted to buy Tesla, instead they bought General Motors. So they lost $1.5 million on the General Motors. They lost $1.5 million profit on the Tesla. So the compliance officer says, well, I looked at our hedge clause. We're only liable if we committed gross negligence, not simple negligence. I think this was just simple negligence, so I don't think we're going to pay anybody any money. We're not going to tell anybody anything. But then you note this on the error log and you note it in the annual compliance review. So the SEC comes in and says, okay, we're doing an inspection. We want to see your error log. We want to see your annual compliance review. Next slide. Now you've got a problem for the compliance officer, and that's the whole point of this. The compliance officer was very cavalier in taking a very aggressive response to an error. Maybe the response ultimately was correct, but he was pretty cavalier in how he approached it and documented it. And now the SEC is focused all over it. So the compliance officer now says, oh my God, now I might be responsible how the firm addressed the error. So what do you do now? My recommendation is step in, do it right, figure out what the answer should have been. So if you were right about the way you made the call back when it occurred, fine. If you were wrong, redo it. Now, of course, that may involve writing a check and telling clients things. And you might go to the inspection staff and say, look, now that I've looked at it, I don't think that my response initially was very valid. The ultimate point here is that errors are not just the business people's problem. Legal and compliance people, when they address errors, can actually get themselves into trouble too. So they have to be cognizant of the fact that they have to meet their own standards in addressing errors. And with that, I think we've got 30 seconds for you, Paul, to finish.
Well, you guys did a great job. And I would add clapping to your presentations. But here we also can tell you that on our resource page for members, there are some materials there that can be helpful to you as you sort through some of these issues. And I also I would say that some of the things that we should think about, you can go to the next slide if you want, and contact the IA legal team with any questions too. But the issues that can be handled here, pay attention to details, make sure you've spelled out in a reasonable way what you need to do, correspond that with how you've handled it in your disclosures, and have people have a sensitive attitude toward handling it at your firm. Hopefully that with as much mechanization as we have, we're reducing the number of trade errors, but that still can happen, and it's good to have a plan as to what you want to do. So with that, I want to say special thanks to Steve Johnson and Rick Marshall for a great presentation today. On the last slide in front of you there is everyone was agreeable to have their emails available in case you want to follow up. I think we covered the questions, but if you have one that you think wasn't answered or wasn't answered sufficiently, you can call us and we can or contact us and we'll see what we can do further. So with that, I want to thank all of you and hope you have a great rest of the day. And the last point is to encourage you to fill out the survey at the end when it pops up for you. And thank you for joining us today, and we appreciate your support. Thanks again, Rick and Steve. Have a good day.
Thank you.
Bye.
Goodbye.